Good afternoon and welcome to our second quarterly price index webinar. Today we'll be looking at how prices for motor insurance and home insurance have moved in the second quarter of the year. So at Pearson, our mission is to help our clients improve performance through better pricing, and that can take several forms. So it can be developing better pricing strategies, helping think through responses to regulatory change, developing product governance frameworks, or providing support with improvements to trading agility, including team structure, processes, and governance, looking at price presentation, taking account of behavioral science techniques, conducting predictive analytics, modeling and price optimization, or providing insights into market and competitor price movements. And that's some of what we'll be doing today. If you'd like some more information on our market pricing insights, then please feel free to click on the link and download the guide that should be available to you in the chat. I should also say, if you have any questions as we go through the slides today, then please feel free to ask them using the chat box, and I shall attempt to answer those at the end of the presentation. So by way of introduction, I'll go through a bit of the methodology. So very quickly, a broad overview of how we gather the data. We'll then go into some of the insights. So what have we seen over the past quarter? And then we shall have the Q&A session. So I'll be able to come back, and any questions that have been asked during the course of the presentation, I'll be able to address those then. Okay, so in terms of the methodology, the data that we use comes from our daily market price tracking services that we have in place. So that involves a panel of real consumers who have given permission for their details to be run through the top 4 comparison sites. So we also have agreements in place with the comparison sites that enable us to do this. We have a rotation of people, so we always have a daily view, so quotes are running every day, so we're able to look at how prices have moved on a daily basis, as well as weekly and monthly, and we're constantly recruiting new panel members to make sure that the batch remains fresh, and we are ensuring that the accuracy of the data that's being collected is maintained. With regards to accuracy, we also conduct data cleansing and review and removal of outliers. We see a number of pricing activities in the market which may be impacted by the nature of the process. So we make sure that we remove anything which would reduce the accuracy of the data, and we like to make sure that we're maintaining that at a high level. Some of the insights that are available via our online portal are shown here as an example. So we can see daily price movements, we can see share of top positions, we can look at different brands and how they are moving, trended or on a kind of a segmented basis. And monthly additional metrics are available, as well as price movements. You can give that a bit more context by looking at compulsory excesses, the number of ticks that are displayed, so the product features and benefits and how those may relate to price, and a bit of scenario modeling around if prices were to move by X%, what would that do in terms of number of top positions being achieved. Okay, so that's the methodology. Now moving on to a bit of a recap on what we've previously seen. So looking back at last year, so throughout 2020, we saw quite a bit of disruption and fluctuation within the market. At the beginning of the year, there were some storms. So storms Kiara and Dennis, which resulted in some price increases, which, along with the pandemic, towards the end of Q1, we saw some increase in pricing there, and reduction in quotability, as well as the market reacted and responded to what was happening. We then saw the impact of a reduced claims frequency flowing back into reduced prices. As that became clearer, then more price reductions started to be implemented, and the market became incredibly intense at that point. So we were seeing a lot of insurers chasing the same volume with price reductions, and obviously driving the market down. Towards the end of the year, we had an announcement from the FCA regarding the pricing remedies that were proposed for general insurance with regards to price walking, and that kind of enabled a bit of leveling off towards the end of the year, as insurers thought about how to approach the new regulations and how to rebalance new business versus renewal pricing. So throughout the course of the year, from January to December, we saw a drop of around 5%. As we moved into this year, in Q1, we moved into another lockdown period in the UK, which again, given the impact on claims and the additional margin benefit to insurers, we saw further price cuts coming in. So prices dropping in the first quarter of the year by the same extent that they had dropped throughout the whole of 2020. So some pretty sharp price reductions being seen in Q1. Okay, so what have we seen following that? So in Q2, some motor prices have come down by about 0.8% during the course of Q2. So it's still dropping, but the extent of the drop is somewhat less than it had been in Q1. Looking at it by month, April and June are relatively flat, with the biggest reduction being observed in May. So I think we can say there's been some leveling off there, but the direction is still a downward one. So when we look at Q1 2 together, so year-to-date view, we can see very clearly the very sharp drops that were being observed in the first quarter of the year have really slowed down. So we can see that indexed line moving downwards very quickly from January to March, and then flattening out somewhat. So we're seeing a year-to-date figure of around 5.6% for motor insurance prices. Over the past 12 months, this brings the figure to 10%. So we, as you can see from this chart, have observed price reductions every month of the year, apart from two. So that was the July and December where there were increases. So the impact of that is prices moving by 10% down over the course of the past 12 months. So thinking about where those price reductions are being deployed, have they been targeted in any way? So what's interesting to see here is the targeting of change that we're beginning to see. When we looked at this in the last quarter, most of the reductions were fairly kind of evenly distributed across the different segments. So we weren't seeing any particular targeting going on. That's changed a bit as we've moved into the second quarter of the year, and we're seeing the biggest price reductions that have been applied to that kind of relatively safe group of drivers aged between 30 and 50, with much smaller reductions being applied to other age segments, and over 60s remaining kind of relatively flat from quarter one into quarter two. taking a look regionally, so by countries within the UK, Scotland actually saw a slight increase in Q2, whereas the biggest reductions observed here were for Northern Ireland. So England coming in around the average, it's going to be the biggest sample within the set. Northern Ireland relatively small, so I think we should take the reduction there with a pinch of salt, given the size of the sample. But interesting to see that there's much more variation in where the price changes are being implemented, much more so than we saw in Q1 at the start of the year. So I think overall, in terms of motor price movement, the message is the prices have continued to drop slightly. The sharp reductions that we had observed in Q1 have leveled off. However, we're not seeing any move into price increases as of yet. And where we are seeing those price reductions, we are starting to see much more targeting. So it's less across the board than it would have been, say, in the first quarter of the year or last year even. And it looks like different strategies are being played out at the moment. So moving from motor into home insurance. So we've seen prices falling in motor, albeit to a lesser extent than in Q1. But what's happened in home? So firstly, looking at combined cover. So in Q2, we have seen prices falling and falling by a greater extent each month as we've gone through the quarter. So the overall impact is a drop of 1.2% in the quarter, but we can see it's gone from 0.2 to 0.4 to 0.7 as we've progressed through this. So I just say there is a footnote here on June. So we are still reviewing some of the compare the market data, and that is kind of pending validation. That's been removed. We will kind of update this once that's been validated, but I wanted to make sure that we had something today to present to you. So the current view is that minus 0.7%, which is for the other three comparison sites. Year to date, the figure is 2.6%. So we can see that every month this year, there have been price reductions for combined home insurance cover. So they're around 0.5% each month. That varies by month. And we can see that April started to kind of level out, but those price reductions have continued to come through into May and June. So again, the message for home is prices are continuing to fall, and actually we're not quite seeing the same leveling off that we see in motor insurance for Q2. So a bit in April, but then falling down again. Contents only, very similar picture. So we're seeing an overall Q2 drop of 1.6%. The April figure slightly positive, so we observed price increases in contents only. But again, as we moved into May and June, further price reductions and to a larger extent than we had previously seen. So year to date, again, it's a similar looking picture to combined cover. So we're seeing reductions every month this year, apart from April, where there was a slight increase, but the reductions there now bringing out the kind of cumulative year-to-date view to minus 5.4%. So I think the message is clear here that prices are continuing to drop in general insurance, whether it's motor, home combined, or home contents only. And we are seeing those reductions in home continuing to increase. So whereas on motor we have seen slight leveling off, on home that's not so much the case. So there was a bit of a leveling in April, but both in combined and in contents only, we've seen price reductions being implemented again into May and June. Okay, so thinking about the market context, so what could be driving some of the changes that we've seen? Aside from COVID, the big issue at the moment is the FCA pricing remedies, which need to be implemented by the end of the year. And it's really thinking about what are insurers doing, what are the potential price moves they could be making in anticipation of that, and are we observing any of those things? So I did a FCA pricing webinar in January of this year, before the quarterlies had begun, and I looked at what was proposed, what was coming up, and potential strategies that insurers could adopt ahead of the changes being implemented, and also following those changes going live at the end of the year and into next year. So I talked about the potential for cashing in, so using this as an opportunity to drive as much high tenure business as possible before the regulations change, so pricing in the old way and increasing the size of the book of business ahead of the new rules coming in. We talked about individual pricing and whether insurers would be able to identify individuals, particularly existing customers, and price them differently than somebody who looked like them because of the kind of the individual and what they knew about that person. We looked at economy propositions and the potential to introduce additional levels of product, so that top positions could still be maintained while the new renewal price and the new business price of the existing product or brand could be maintained, and the alignment kept between new business and renewals. We looked at improvements in model sophistication and improvements in risk modeling, and to make sure that risk selection was as good as it could be, because that is kind of more kind of reliance would be on that side of pricing, and legitimizing price increases based on information that is known about the individual customer at renewal that may not be known at new business. So things like driving behaviors, telematics, and those sorts of tracked data sources coming in, and also looking at rate offsetting. So where prices are rebalancing, so if we have a view that in general renewal prices need to come down and new business prices need to come up, that doesn't need to happen to the same extent for all segments, and where would the benefits be in being more targeted about where those price increases and reductions were being applied. So I'd like to look at now, well, have we observed any of these strategies in the past quarter or this year, and what do those look like? So when we spoke about economy propositions and the kind of the potential to increase the number of tiers and products available in the market, I think, yes, we have seen quite a bit of that going on over the past few months. So if you're looking at the price comparison sites, then we've had several new brands being launched by existing providers. So different levels of cover, whether it's branded as economy or basic, or whether higher level products have been introduced, such as gold or platinum. We're certainly seeing a lot more activity in product proposition and tiered pricing. So I think that's something that's definitely forming part of some insurer strategies when it comes to making sure that the new business and renewal prices are aligned through the same channel for the same equivalent product. Then they're making sure that there are other products which are available which may not be equivalent, and therefore not subject to the same alignment between the renewal price that's being quoted for the customer and what's being presented to new business customers online. Cashing in was the other strategy that I spoke about, which was something that we were expecting to see this year ahead of the new regulations coming into force. And I think looking at the price movements that we've seen over the past 12 months, then there's certainly some evidence to support that as a strategy that we're seeing playing out at the moment. So prices have come down 10% over the past year. We've seen kind of big reductions, particularly in Q1 of this year, and in Q2 there has been some leveling off, but the direction is still slightly downwards. So I think that there is some of this. There are obviously other factors which are impacting and influencing this. So I think in Q1 there was an additional lockdown, which was kind of unexpected at the end of last year and the beginning of this year. So that's something which, again, the impact on claims is going to push market pricing downwards. There's the Ministry of Justice portal and the whiplash reforms, and again, a potential there, external market force to push prices downwards. So it's not just the FCA changes that are coming up, but there are other factors at play which could be influencing the way that prices are moving. And another strategy that we spoke about last time was rate offsetting. So greater targeting of price reductions that we've seen in Q2, I think may be supporting some of this. So looking at the areas where prices have been reduced to a greater extent than some of the others. So again, it could be cashing in and trying to drive more volume in areas where the retention rates are traditionally higher. So you can expect to retain more of those customers if you bring them on board now, regardless of what pricing looks like when it comes time for their renewal. And I think we can see that by driver age and thinking about the kind of average premiums and behaviours of people within those segments. Looking at it at a nation level, where Scotland has an increase. Now, if we're looking at the charts here and making an assumption that typically retention rates may be lower in Scotland, then that again could account for some of the differences that we're seeing. So I think we're probably likely to see some more of that happening as we progress through the year. So we didn't see so much of it in Q1, Q2, it started to appear. As we move into Q3 and 4, I think there's going to be a lot more of this targeted activity going on as insurers start to deploy some of the pricing strategies ahead of the pricing remedies being implemented. Okay, so what next? So thinking about where prices have gone so far, what do we expect to happen for the rest of the year? So this is a forecast that I shared in January, actually, when we had the FCA pricing webinar, and I gave 3 potential scenarios that I thought may play out. So a kind of medium, high, and low version. And I indicated what we've actually seen with the red dotted line here. So actually, we are in line with the original forecast, albeit at the lower end of it. And I think that's really been driven by the sharp price reductions that were observed in Q1. I think when I did this, that it was before the lockdown had been announced then. So I think the expectation was that there would be kind of a reduction in prices in Q1. I definitely expected that to be the case. I hadn't quite realized that the extent of the reductions would be equivalent to that of the whole of 2020. But what we're seeing now since then, they're kind of leveling out. Again, that's kind of in line with expectations. So we are currently at the lower end of the estimates. However, the trend that's been observed over the past 3 months suggests that the pattern will look more like kind of the medium or the higher, and I would expect probably the medium. So if we're looking at the trend of the medium applied to the actual line that we see here, then I think we would expect to end up somewhere between the previous scenario 2 and scenario 1. So the medium or the lower estimates on what we would expect. So I think as we progress through the year, that's the kind of the trend that I would expect to see. So some leveling off until the kind of the middle, July, August, moving into a period of starting to see some of those price increases flowing through ahead of the regulatory change as renewal and new business prices start to rebalance. Okay, so I'll take some questions now. Let me just check the chat to see what's come in. And if you haven't already, then please feel free to ask any questions at this stage. So I have one here around what do you expect the impact of COVID to be in the medium to longer term? So I think it's an interesting time as we come out of lockdown and the easing of restrictions, turning into a kind of a complete kind of end of any legal restrictions at the 19th of July. Then it'll be interesting to see what that does in terms of kind of the mix of business out there. So the types of people on the road, in occupations where they're unable to work from home. So I would expect quite a lot of people to continue to be working from home at least part of the time. So the mix of occupations may be changing on the road, the age mix where it's been more difficult for younger drivers to come into the market. So we see, I think, an uplift there, newer vehicles coming into the market. And I think generally people who have had no exposure to driving for extended periods, so that there may be an increased risk in the profile of drivers that we're seeing. So again, looking at market forces pushing prices upwards, as well as kind of looking at the rebalancing of renewal and new business prices. I think there are, and there will be kind of there will be a deterioration in loss ratio, which again will be looking to kind of force prices upwards. So that's what I see. So when we looked at the previous forecast, it's not just about kind of what we expect based on the kind of FCA changes, but there are also factors such as coming out of COVID, which are going to play a part there. When do you think insurers will start to deploy rates in response to the FCA changes? Well, I think we're already starting to see some of it. So when we were looking at a kind of rate offsetting, we've seen that some of the changes in Q2 have started to be more targeted. And I think I would expect that and kind of that to increase as we move into the kind of the next stage of the year. So the second half, I think there will be a lot more of that going on. I think some rates have probably already started in advance of the changes. That's going to continue from now until the end of this year, and then kind of there's the kind of the next phase. I previously spoke about the 3 phases of the regulatory change. So now in advance of the implementation, 12 months following the implementation, and then beyond that. So I think there are 3 kind of distinct periods that insurers will be developing strategies to address and deploying rates to kind of respond to those. Okay. So I think we are kind coming to the end now. So if you would like any more information about what we do in pricing at Pearson Ham, then please feel free to download the guide, which the link should now be available. Or please contact me directly if you want to know any more about our daily motor and home price tracking insight tools that could benefit your business at this uncertain time. So it's certainly unprecedented time in the market at the moment, and an understanding of when and how prices are moving is going to be more important than ever this year and into next year. So thank you very much. As I say, if you have any questions or would like any more information, then please feel free to contact me using the details here below. So you can give me a call or email on stephenkennedy@pearsonham.com. Thanks very much, and look forward to seeing you next time.